Durable goods orders actually coming in better than estimated, up about 0.8% in September. And if you strip out, say, transportation, not as great, but still up by 0.1%, David.
Transportation is always the lumpy one. So I want to bring in Mike McKee now. He's our international economics and policy correspondent. You always interpret these numbers much faster than I do, Mike. What do you make of it?
I'm looking at it right now to try to...
You had 30 seconds. So
yeah, I've had 15 seconds here. Let me quickly go through this and say that it looks like, well, here's an interesting number. Fabricated metals orders down 0.7%. This may be a result of the tariffs. So you start to look at that. And a lot of declines in electronic products and computers also could be part of the tariffs. Non-defense aircraft down 17.5% after a 64% gain the prior month. That is obviously Boeing and the lumpiness of their orders. So that's why we look at ex-transportation. But what you really want to look at is the capital goods orders, non-defense ex-aircraft. That's a proxy for business orders. You throw out Boeing and you throw out defense orders, and you're down 0.1%. That's the second monthly decline in a row, and that is a problem because I got a chart here. Let me call this one up. What we were expecting was a lot of investment after the president's tax cuts for corporations. They were going to bring all that money home and they were going to start investing in it. As you can see, the chart shows that we are not seeing a big rise in investment. We're seeing a static to down area. Now, month to month, it's lumpy, but it is not showing the acceleration that the president was looking for.
Also, I was struck, though, by the durable goods new orders were actually revised up for August. So that was like something. Like, I mean, new orders, like, are they as lumpy as everything else?
Well, if you're looking at the overall orders numbers, again, that gets influenced by a lot of things like what's happening with cars and what's happening with airplanes, which is why economists go to the non-defense ex-aircraft orders.
But that investment number, I think, is key, because if you're going to sustain growth, you need increased productivity, unless you're going to add a lot more workers. And that was the hope of the administration, is that those tax cuts would really cause a lot more capital investment that would boost productivity. They could keep this 3.5 plus 3 plus number going. If they can't get the investment, that's going to be a challenge.
Other problem in these numbers today is we got the trade deficit, the advanced trade deficit figures. It is wider than expected. Another chart I brought along here just shows what's happened to the trade deficit since the president and his tax policies came into play, and it is getting worse. And that's what every economist predicted, that if you cut taxes significantly and raise the deficit, more money's got to come in from overseas. If the economy picks up, more people are going to be buying imports, particularly in a full utilization economy where we can't necessarily make the products that people want. So the trade deficit gets worse, and that is a drag on growth.
So we're definitely seeing Mario Draghi settle down, sit down right before that press conference. A little late, this guy. He was like on time last time.
He knew we had to do the numbers, too.
That was really helpful. Mike, one quick thing is that you look at wholesale inventories. They were just up 0.3%, so disappointing. Retail inventories coming in 0.1%. Walk me through what that means for the future.
Well, if inventories are down, it's not as good a news for growth overall. Now, wholesale inventory is very closely tied to trade. So if the trade deficit is going down, if exporters, we don't have those numbers yet, since this is just the advanced number. But if exports and imports are down, you're going to have fewer inventories on the docks. Retail inventories, you know, if companies want to build up, they got to sell more, they got to have more inventories.